time here.
That. All right, so we're recording now. Sam, Tony, Jonathan, Kevin, Christy, thank you guys so much for joining us. So we're kind of doing starting a new deal here with Multifamily Masters. I'm going to say Multifamily Masters Oregon. We got Portland and Eugene teaming up for the next couple sessions. Chris and Denny are hosting out of Portland, and I'm in Eugene. So really happy to have you guys. This is, free content, free education, free networking. Just hoping to help you guys advance your real estate careers, your goals, any way we can. So we got Steve Wiltshire joining us tonight. Steve's got a little over 17 years in the lending space for commercial real estate. So questions you guys have, this is the guy you want to talk to. So don't be shy, ask away. There's no bad questions or anything like that. We're all here to learn and help each other out. Steve, you want to just go ahead and take a few minutes to introduce yourself?
Glad to do it. I appreciate everybody here, and I appreciate the opportunity to at least talk a little bit about what we do and where we do it at, so forth. My name's Steve Wiltshire, and I have a company called MFM Capital. We're a team up here in Portland, where we're based here, and I've been in the business for pushing 20 years in financing, different positions. I was involved with a company called First Fidelity Lending for some time as a COO, Bankers Mutual as a capital director for a group called Marcus and Millichap for about 4 or 5 years here in the Portland branch, and MFM Capital has been going, I think, somewhere, I think it was 2004 we started it originally. But focused on debt and equity positions in some aspects, but primarily debt in regards to commercial real estate. As a company, we are focused here, but we do business around the country in just about every product type. So as we get into other markets, other products where you start talking about office, we start talking about retail, we talk about niche properties, things like that. Certainly there's opportunities there. But today we're talking about multifamily. As far as a company, we've done transactions up $60-70 million single transactions down to $1 million transactions and even a little bit below. So it just depends on the situation and the deal. But we've also done some pretty complex transactions when it comes to the ownership structure. As you start stepping up in size, then the ownership structure starts to get a little more creative, and something that we're pretty versed in. As far as types of platforms that we do, we're involved with talking about multifamily specifically. We do a lot of Fannie Mae, Freddie Mac type transactions, non-recourse, which we'll get into talking a little bit about that versus recourse debt. We also get involved with HUD. We also get involved with banks that we're partners with, as well as credit unions. And we're a correspondent relationship lender with a couple of nonprofit banks with mission-driven statements, and then also some correspondent lending with some life companies. So depending on the project, there's certain platforms that make more sense to the product and to the goals of the investors. We are focused on investors primarily. When it comes to the other products, we don't do a lot of owner-occupied things commercially. A little different business, something we have done, we just choose not to. We kind of focus on the goals of the investment and the investors. So as you get into this and you have some questions pertaining to your specific situation, glad to bring them up, glad to talk about them. We can certainly go through that process. So multifamily is what we're focused on today for you guys. There's a little different platform and some requirements relating to multifamily at different sizes, different types of properties, different positions that the properties might be in, whether they're stabilized or they're not stable. And that's a broad term today, which I'm glad to kind of cover that in the marketplace today. So unstabilized properties, we're seeing quite a bit given the COVID world. So we'll come back to that a little bit. I'm assuming everybody's familiar to some degree with how we look at real estate as a whole, or how we look at multifamily. But some of the first things that we're going to do, that we attempt to do when we're looking at a project with a client, is we like to understand the project as a whole. And the first thing we do start with is understanding different components. The components, when you're looking at any commercial real estate, we're going to typically start with understanding the structure. The understanding, is it an LLC? Are we dealing with a C corporation, an S corporation? Are we dealing with individuals that are claiming everything through their tax return? Those make a difference as to how many packages are being put together. Some lenders, what they require, some may not want anything other than an LLC. So it just depends on the deal. So we tend to start with understanding the structure of the deal. What we call the 3 C's is typically we look at the collateral, we look at the client, and then we look at the credit score. Credit score is less of a focus when you start a project. I'll just say that. Usually I get a call and somebody says, I've got a credit score of X. In the commercial world, you have to have a good credit score, period. If you don't, typically it's north of 720. If you don't, we usually run into problems in other areas. And there's a reason for it that we tend to focus on it. But it's usually the last thing that we look at, because of the assumption we'll have a discussion, a dialogue. If there's ever a credit issue, we always encourage people to bring it up earlier than later, because it might be a non-starter. It might be something that you have to address. And we've had very seasoned individuals that might have had litigation 20 years ago that is coming up today. So it does come into play quite a bit, but again, it's usually something we want to address early on. When we look at the client, some of the things that we're exploring is we're looking at the assets, we're looking at the liabilities, we're looking at the schedule of real estate, the experience level they have with the product. For example, if you've got 10 unit, 15, 20 unit properties, and all of a sudden you want to leap to a 100 unit property that is out of state, you're going to be faced with a little bit different challenges in the lending side that you have to overcome, that maybe you wouldn't have otherwise if you're just doing a 25 unit property around the corner from you. So some of those things we address, and we can come back and talk about those. We also are looking at the experience level in that type of a product or that size pretty heavily. If it's outside your scope, we're going to talk about it. If it's right down the fairway with what you're doing, that's a good sign. Assets, some of the things just to keep in mind. Assets, one of the things that we look for in the industry is that we like your net worth, which is your assets minus your liability. We want your net worth to equal the loan amount you're requesting. So one of the first things we get is a personal financial statement. Those things will detail those items out. We up front try not to get too deep into them, but we want to know what numbers we're looking at. In the industry, you really want that to be equal. So if you're doing a $10 million deal, your net worth needs to be somewhere close to that. If we're doing $1 million deal, somewhere close to that. If the other thing we look at in the financial statement is your liquidity, your cash position. One of the terms that we use is post-closing. So we're focused on your liquid position of cash or marketable securities that can be converted to cash within a 12-month period that you have access to, not that a lender has access to, but that you have access to. And our goal is looking for a number of 10% of your loan amount. Those are your magic numbers today. Net worth is equal to your loan. Liquidity is equal to 10% of the loan request. If you have less, it's not a deal killer. If you have more, it's a great position. The goal is, that's an easier number to remember, but the goal is to have, depending on the lender, 9 months to 12 months of payments. In the event that your tenants stop paying rent, which if any of you are owners today, I would suspect you're probably dealing with a little bit of that right now. So if they stop paying rent, you have the ability to continue to pay that payment for at least a set period of time. And these are some boxes that we're trying to check as we're doing the first look at a transaction and understanding the client so that we know going forward what challenges we might have. And those numbers can be made up in a lot of different things, and we can get into specifics, but those are some key things to keep in mind in any transaction. As you get into larger groups, that becomes a little bit less and less of a concern. But I will tell you, it's still of concern. If you're doing a $20 or $30 million deal, you've got to have a certain amount of numbers available. And it applies there as much as it applies at a $500,000 transaction. So it's just something right off the bat that we tend to look at. Next thing that we're going to kind of dive into is the property. And the property is key. And in multifamily, we're looking at the age, we're looking at the condition, we're looking at location. All of these things weigh in heavily to the value of the property in relationship to the capitalization rate. Capitalization rate is a process or a rate of return in determining value in relationship to the operating income of a property. And let me know if I'm getting into areas that this is beyond what you want to listen to, or you already know it and you don't want to hear it. But these are some of the basics that we're kind of focused in on to start a deal and see how they move forward. Cap rates today is a topic all in itself, capitalization rates. If you think about capitalization rates, it's a term in which if you consider we lend money today and we foreclose tomorrow, what would be the expected percentage of rate of return that a lender might have that next day based on its cash flow? Those are how the lender looks at it, but from an investor standpoint, you're looking at that rate of return for your investment. You might use other components, internal rate of returns, return on equity, there's all different variables. But from a cap rate standpoint, that's what we're trying to focus in on, given the market and the condition, quality, et cetera, to determine a value of a piece of real estate, which tells us if we're going to be close to what the expectations are by the investor relative to the request of the loan amount in relationship to that value, or if we're doing a cash out transaction, is there value in that equity to be able to draw upon? If somebody may look at us and say the property's worth, $200,000 a unit, but that cap rate will get you to 150 a unit, we may run into a problem trying to hit where somebody's looking for. So we tend to look at a little bit of that in the process as well. The income is really key in commercial real estate across the board. In multifamily, we are always focused on the rents coming in. We're always focused on any additional ancillary income that is coming in on the property. And then we're looking at expenses going out. No different than you folks do as an owner. You're going to be looking at what I'm going to end up at the end of the day, the net operating income that we have to work with and pay our payment, or what we end up, being able to spend at the end of the year. We're looking at the same information. However, we're also going to be looking at it a little bit deeper and adding a few things to it that maybe you wouldn't otherwise add to it, or take away some of the income streams that you might look at as your own income, but from an underwriting standpoint, it's going to be a little bit different. So let me kind of get into that. When we're looking at multifamily, today's market, you've got the rents coming in. And in a lot of cases, the market's shifted a bit over the years, where you're actually able to charge a reimbursement, what we call RUBS, to the tenants for maybe electrical, for maybe water, for maybe gas usage. Some companies are charging a flat rate fee for reimbursements. Others are charging a percentage of the actual billing. So it depends on the property and the management style and the location. Other areas that you might be looking into as far as income streams are going to be pet rent. We're going to be laundry income. You might have a laundry rental. We've got some properties where there's an upcharge if you want to rent a washer and dryer in the unit yourself that has a hookup rather than buying your own. So all of these are income streams that we can in fact count. We can count them if they're continually being collected and they have systemically been collected for a period of time. If it's a new program, then we might wait to give credit to all of it right away until we see some track record of it being collected. When we do collect information on property, we tend to collect as much information as we can. In the business today, we do want to see historical financials. Generally, we like to see, depending on the age of the property, but we do want to see at least 2 years of historical year-end statements. We also like to see year-to-date statements, and we also like to see the current rent roll of today. So that tells us a lot real quick about how the income stream has happened and will happen for the property moving forward. Same thing with the expenses. The expenses we tend to look at historically as well as current year to date. Today, you might see some changes if you've been involved with it for a while, that we're requesting documentation on a month-by-month basis. The month-by-month basis allows us to see trends. It allows us to see what part of the year we've got increases or decreases. We do business in Montana, for example. Montana tends to have a higher cost in the wintertime for snow removal. So if somebody were to give me a snapshot in November, and we take the income and expenses, and part of our processes will annualize that out over a 12-month period to project what we expect it to be. If we use that higher expense factor, it's going to be a higher overall expense for that underwriting and might otherwise impact your cash flow or loan amount. So when we're looking for month over month trailing numbers, we take those and we look at the trends, so we know that some months are going to be high, some are going to be low. So you'll see some requests coming in, and if you haven't been experienced with that, that's relatively newer in the last couple of years, is getting month-to-month trailing numbers. And there are some calculations that we use comparing trailing 3 months to trailing 3 months to trailing 12 months and trying to find trends and see what that property is truly doing. If it's a new property, then that gets a little more interesting because there is no historicals. What we end up doing is we end up working on pro forma basis that you think it's going to perform. We look at some of the trends that we see with other properties in the area to see how they're operating, and our expectations are set that way. We also at that point defer a lot to the appraisers, and then the appraisals will be doing the same thing. They're looking at historical data from other projects and bringing those into their workup and trying to decipher what this property might have moving forward. Any questions so far on any of that? Okay. So as we start looking at the expenses and income of the property, some of the things just to keep in mind when we do underwrite a deal, we are looking at that income side, giving you credit for all of the income, with the exception of late fees, lease breakage fees, things like that. We really don't want to see. It's great to show as an income, and we see that a lot. You know, sometimes it's an income we can use, but we don't really want to see that because that tells me we've got problems. So it's great to catch it as income, but the flip of that is you've now probably had a vacancy issue, and now you've probably spent more money on turnover costs. So it tends to wash out to some degree, but it does give you a little bit of pause to say what's going on here. And we are seeing quite a bit of that due to COVID right now. So that is a bit more challenging. We can use other income sources that are not typical income streams, such as your laundry and your pets and rubs, as long as they do not exceed 3% of the gross income, they can be used. If they're a large part of your income stream, they won't get used. So just keep that in mind when you're looking at it.
Hey Steve, on that note, so on another income line item, things like an admin fee or application fees be included?
Yes. Yeah, because they're part of the ongoing operation and the income stream that would be traditional to collect the rents and drive those rents. So you're also going to see some administrative costs associated with that, having an admin, on staff to do that. And sometimes you might have to pay for those background checks and what have you. So those will somewhat wash out. So we want to be able to collect and show the income and give benefit to the income, because we're going to hit you with the detriment of the expense. So it becomes a little bit of a wash and somewhat of a dance sometimes with underwriting. But for the most part, yeah, we can use that. When you start looking at the income, we're going to take, let's say you've got 100% occupancy. Occupancy is a big factor always for you guys as well as a lender. Occupancy pays the income, pays the bill. There's two different types. One is physical occupancy, and which we all know, you got 100 units, you got 10 people gone, you got 10% vacancy, great. But economic vacancy is more important for us. And the difference for the two is, if I have 100% of occupancy, 100 units filled, I've got 10% not there, I've got a 10% physical vacancy. But assume I've got 100% of the people there, 100 units are filled, and 50% of them are not paying the bill. That's actually more detrimental. I've got a 50% economic vacancy. Even though I've got 100% body count, I've got 50% of the people not paying their bill, which in one aspect, you're looking at not seeing the income, but even more detrimentally, you're not seeing the income, but you're also seeing the expenses continually going up, because they're still using heating, they're still using the services, they're still doing wear and tear on the property. So when we look at a property's income stream, we're focused on the rents by month. When we're looking at that, when we look at the trailing month by month, we're watching those trends to see if the amount that's supposed to be collected is being collected. And if we're seeing a substantial drop or rise, or drop or rise, then a lot of times that's accounting methods. But if we're seeing a decline in those income numbers, but yet our body count's still there, that's kind of telling us that we have some delinquencies on rent. So we might dive into that a little bit more, which isn't what we are experiencing today due to COVID, right? Because you do have restrictions on evictions and so forth. So you do have some folks that haven't paid and that are delinquent in their rent, but they're still in the facility. Therefore, they're still using the power, water, sewer, and so forth. So it does weigh into underwriting a little bit heavier today. With that topic, we are looking at the economic vacancy a lot harder. And in some cases, if it's a continue or a constant economic, meaning that we've have folks that have been there for and not paid for 6 months, we now have to consider that as part of the physical vacancy, because once those moratoriums are lifted, chances are that individual will leave or be asked to leave. If we do have some lenders that are giving us a little bit of latitude today, if it just happens to become vacant, or maybe one delinquency recently, even during our process of closing a loan, then we'll look the other way, because that's a snapshot quickly. It's not systemic. We don't want it to change our direction, nor does the lender, but we'll keep an eye on that as we move forward. So, and that is occurring. Even one of mine yesterday was the first time I had a tenant asked to defer the rent, which, knock on wood, first time for the properties this year. So I'm happy with that. So those are things that we are looking at. When we do underwriting for income, we will always calculate and underwrite a 5% vacancy or market. If the market is 7, 8, 10, that's what we'll underwrite. So if you take your income, we're going to reduce your income by at least the 5% or market. Now, in the real busy times a few years ago, we saw some markets with 3% vacancy. So we were actually able to use that in underwriting because it is the market condition, especially on larger properties. You want to be very careful on the smaller unit counts, because it doesn't take much to get a large vacancy number. So typically a stabilized property is considered 90% occupied. Okay, if you've got a property that's either economic or physically less than that, we consider that a non-stable or an unstable property. And if it gets below 80%, you won't see a traditional loan being approved on it. We have options for non-traditional, where you've got other areas where we can do a loan based on its cash flow and then earn out additional funds as it stabilizes. Or we're looking at some type of a bridge structure to buy you that time to do whatever needs to be done to get that occupancy up. New properties specifically are a little bit of a challenge. You've got a lot of new builds happening in the city of Portland, less than 20 units. There's reasons for that relative to the municipalities and the rules regulated by the city and Multnomah County relative to affordable housing. So you had a big surge of 20 units and under being constructed due to restrictions on over 20 units. That units had to be affordable housing over 20 units. So you see a surge of 20 unit construction going on right at the start of this. Now you've got a lot of properties that are not occupied, and due to them not being occupied, they've got a high vacancy. And when you've got 10 units, 2 vacants is 20% vacant. So it's an unstable property. So the smaller the unit count, the more challenging it is to address that vacancy number. Again, we're going to take that vacancy off of the income stream. When we look at income, we call it a gross potential income. When you take your vacancy number, it's an effective gross income, because there's never a situation where you're going to have 100% occupancy in a building. Even if it's a day or two or a week of a transition from one tenant to another, you will have downtime. So the industry has defaults, and we tend to set those at 3 to 5%, and or what actually is happening on the property. So that's what we're kind of getting into the underwriting a little bit deep, but those are things that we look at and why we look at deals, and how, when you're looking at a project, maybe you want to consider the same thing to understand the true operation of owning it as opposed to best case scenario. Expenses, something that we do underwrite in expenses. We see a lot in smaller properties where they're self-managed. You do your math, you get your number at the end of the year, you're making great money. You're underwriting or you're managing that property, it's running fantastic, they all love you, that's fantastic. When a lender looks at a property, they're not going to ever manage it themselves. So when we do underwrite a property, we're going to put a management fee in our underwriting, always. A bank doesn't look at a project as if you're going to fail. It's when you fail, they're going to have to take it over. And when they take it over, they're not going to run it like you're running it. They're going to hire everything out. They're going to make sure the property runs itself, manages itself, performs replacements on its own, does everything on its own before they have a chance to liquidate it to somebody else. But when we underwrite with that mentality. We're going to have a management fee in there. Larger properties, generally, you get over 100 units, and we're usually seeing 2.5 to 3% as a management fee. 5% is pretty traditional in underwriting. We get into the smaller properties, what we're seeing a lot of is management companies charging 6 to 8%. It's relative to the income and the time and effort. So we tend to advise on some situations where maybe you can negotiate a better percentage rate on the management fee. And if I have a contract that says 4%, I won't use 5 in the market, I'll use 4 because I have a contract. Be careful of management contracts because the devil's in the details. We see a lot of 2.5, 3% fees, but ultimately they're paying 12 by the time everything else is added into the true management. So when you're looking at administrative costs, payroll, maintenance, salaries, things of that nature, it adds up to manage the property. So when we look at properties, we tend to explore where those expenses are at. And if it's a sale, then we have the luxury of maybe making some adjustments. If it's a refinance and you're going to keep everybody the same, then we're obligated to take the same income and expenses and trend those out as if nothing's going to change. So if you guys start looking at properties and you believe I can run this property better than the other people, fantastic. You know, we'll work that angle. We'll address what we need to address, and in a lot of cases, if you've got other assets, we can bring in your performance from the other properties and use those for justification for underwriting that says you do better than they do. And this is why this property is not running well. Moving forward, it will run great, and here's why. So that all helps in the process. When we're looking at expenses, we will tend to look at the trends, and specifically, depending on where you're located, in Oregon, I'll pick on, typically you got a 3% growth in your utility costs, a 3% growth in your taxes, and we're seeing about a 3 to a 5% growth in insurance year over year right now. Insurance is moving up the ladder pretty quickly. So we will actually take your historicals and we'll average those or trend those forward in our underwriting, and we'll make a determination on a loan amount relative to debt coverage ratios, which we'll address next, and how that property is going to perform. Those performances are based on trending forward. Additionally, we will also put in what we call replacement reserves. Replacement reserves are money set aside to replace the items. Typical multifamily have about 10 years are what we see the majority of our life in a lot of the multifamily product for a lot of the components. So we see a lot of 10-year funding, financing, and there's various reasons for investors to look at shorter or longer. 10 years seems to be an average number time frame. We do a lot of our projections off of 10-year money, and what we call an exit strategy and underwriting to be able to get you out of the loan when the loan comes mature. 10 years is something that we see a lot and use a lot. Multifamily in 10-year period, you're going to have it. If it's a brand new building, you're going to have half the life of a roof done. You're going to have windows and doors that most likely will be getting close to that. You're going to have appliances that have a 10-year life expectancy. You're going to have paint that is a 10-year life expectancy. So typically at the 10-year mark, you're going to start putting more equity or capital back into that property. And that's the time a lot of folks tend to sell it, realize the equity, parlay it up to the next investment, and move forward and increase the assets. Otherwise, they're putting capital in that building, and it's very difficult to get a $100,000 roof replacement out of increasing rents for the next couple of years, you know, given what we've got limitations on rent growth. So those are the things that we're going to underwrite, and we're going to assume that those things are going to fail, and we are going to lay out a projection of where and when those items should fail pending what's been replaced, and that will calculate a dollar amount that we put in and collect on an annual basis for what we call replacement reserves. We encourage owners to do that, even if we might underwrite them, but we don't always necessarily collect them as part of your payment, like a principal, interest, taxes, and insurance. But we encourage at least the owners to calculate those, because what usually happens is, like most folks, we get to the end and we got to replace this stuff. We'll go refinance the property. 2008, if you guys were in the business, refinancing wasn't really an option for a lot of cases. There was no money available. So if you had a leaky roof in your apartment building and 10 units are being rained on and you don't have the capital set aside to do that, getting that money became very difficult. So it's best to have it planned for and prepared to do that. As a lending institution and brokerage, we're going to do that. We're going to calculate that, and in a lot of cases, lenders will require it collected, depending on, you know, what needs to be done in the near future or long term. So when we take the income less the expenses, and we take all of your expenses plus our expenses and calculate what the leftover amount is, the net operating income to operate after operations of the property, we're going to take that number. We're going to figure out what the loan amount is that can be supported by that money left over. And the payment that we calculate for a loan is termed as a debt service. You've got a loan obligation, that's the debt service against the property. You might hear a term called debt service ratio, DSCR, debt coverage, debt service coverage ratio. These are terms that get thrown out a lot. DCR is something that we focus on in every property, and every platform has a set of rules related to what they require. Debt coverage ratio primarily is what you got left over. If I've got excess capital left over in the net operating income, how much do I have to pay the payment? Going back a few years, back in 6 and 7, we had debt coverage ratios that were 110, 1.10, and 1.15. And in other platforms, even today, we have debt coverages at 1.0, but those are typical bridge and other creative structures. Typical financing for multifamily was 110, 115. What that means is that if it's 110, you have 10% more net operating income than your payment going out. It's pretty simple to look at. If it's 115, it's 15% more. If it's 125, it's 25% more. Today's lending typically is 125. We want to see more positive revenue coming in than the expense going out on the payment by about 25%. We do have lenders that'll go to 1.20 today. So you've got a little bit of flexibility. So when we underwrite a deal, we're trying to determine the performance of that property. And if we can't quite get there at 125, we know that we have solutions and sources for 120. And albeit the loans might be a little more limited, but you have the ability of getting to where you need to go based on the performance of that property. So debt coverage is what it's really about. If you get into the other properties, it's 1.30, and in some cases 1.40, and we're getting into office product today. So much more heavier requirement for excess capital on that property's performance on some of the other products. Multifamily is probably the it's really the sought after product today. It always has been, always will be. It's deemed to be the lowest risk, so we generally get the highest leverage on the property, depending on the platform, as well as the lowest debt coverage ratio. Typical lending with multifamily, you can go up to 75% LT loan to value. Unless we're doing agency transactions, Fannie, Freddie, we can do 80 on acquisitions or non-cash out transactions. HUD, you can actually go to 83% and incorporate some of those costs. HUD is an entirely different animal. Great platform, expensive, very restrictive, but it's probably the best platform you have from a rate standpoint, AM standpoint, across the board. But it becomes a little more challenging for a lot of folks if you are managing and using your property as income streams. There's a lot of restrictions on how much money you can take out of the property and when, and so forth. So it becomes more of a specialty type discussion.
Hey, Steve,
Yes.
On the loan to value right now, given COVID, are we still seeing the typical 75%?
Yes, if the property cash flows, that's the challenge. So the platform hasn't changed. Still 75% loan to value in most institutions and platforms, but the collection ratios, the income coming in that's truly being collected, is what's affecting the debt coverage. So in all platforms, you have two components. It's going to be the loan to value maximum that they'll lend on that product type, and the minimum requirement for debt coverage. In underwriting, whichever one gets hit first or hits that threshold or that dam first is the stopping block. So for example, if my debt coverage is hit at 125, but really I'm at 50% of its value, you can't go in and say, well, I can go to 75% of value because that's the platform. Whatever one gets stopped first is where you get capped. If we've got a property that's cash flowing at 135, 140 at multifamily, but the value's not quite there, which is a little odd, that then you'll be limited by loan to value. So And in those cases, we go into a situation where we're underwriting and somebody might say it's worth X dollars. We'll use that number to start with and see where it comes into play. And if we have to make some adjustments, then we'll go out and pull our comp data and support that with maybe changing value. Sometimes we'll run into that situation where we'll use that value as discussed and the property's cash flowing fantastically. So maybe your value is a little bit off, or maybe we need to really evaluate that. Maybe other properties in that market, haven't set a comp or comparable for us to use that works well. So we might explore outside the area, use the same metrics as the location, and use comps from a different area. That's where we get into some creative stuff when we're working with our appraisers. So not that we can dictate what the appraiser says, but we can certainly provide information that assists them in their job. So, and a lot of times that is pulling supportive data to aid in hitting where we expect it to be. So depending on which one gets hit first, that's our stopping point. So
why don't we just pause for a sec, open it up, see if anybody has any questions.
I've got one. Going back to vacancy that you said you underwrite. See, was that 5%? Is that total economic or just physical?
There's a couple ways to look at it. A lot of times, well, we underwrite it both ways. We underwrite it with rent only, and then we underwrite it overall income stream. So underwriters typically look at the overall, but from an appraiser, they look at the rent. From a property management company, they look at that ratio against rents only. But there's also a consideration that when you have a vacancy in rent, you're also not getting the same rub. You're also not getting the same utility expand or income stream. You might not be getting the pet rents, so it tends to tie into it. As a company, a lot of times what we'll do is we'll take a more conservative approach where we would rather deliver at the end of the day than, and so therefore we go a little more conservative, and we might hit the properties underwriting a little bit more greater than what maybe an underwriter would, because when we set an expectation with a client, we want to be able to deliver that. We have about a 98.9% delivery ratio on any application that we take in. But that's because we spend a lot of time up front understanding the deal before it goes to underwriting. Because once you get a term sheet from a lender, you're now putting money into this deal, and we don't want you risking money if the deal's not going to make sense. So we'll underwrite it a little bit more conservative, and if we get too aggressive, then we'll get pushback from underwriters and credit groups, and we don't want to have to readjust that or retrade the deal. We want to make sure that we can deliver at or better. So for us, we tend to be more conservative up front, and then we'll refine it as we get deeper in with the credit guys and underwriting guys.
Steve, that's also a good segue into when should an investor reach out to you? So if they've got an eye on a deal, when's the ideal time for them to bring you in to start discussing financing? Well,
we prefer it way earlier than later. And the reason we want it earlier than later is that we can, it allows us to see the roadblocks. It allows us to see the stumblers, the gotchas. And we, a lot of times, and I encourage this to anybody, we absolutely love to do it. If you're looking at acquisition of a property, go ahead and send us the data that you're looking at, because we are glad to run the analysis, run the underwriting on it, and give you some feedback on areas that we think there's some concerns, because we know what's going to end up happening in underwriting. If we're seeing an anomaly or we're seeing a problem, if we're seeing some issue that we know is going to be a challenge, we'd rather see that up front. And the sooner we see that, the better off the process is for everybody. Typically, a process to go through a loan start to finish is really based upon when you sign a term sheet with a lender. Whatever lender you're choosing, when we usually lay out a matrix of 4 or 5 options, and even if the rates are the same, you will find there's nuances with each lender. Some lenders allow you to pay additional principal against the property. Some will not. Some will, even if the rate's identical, some will allow you, maybe they'll do their calculation on a 365-day calculation for interest accrual against 365 year. Others will do it on an actual month versus 365. The difference is more interest paid by a client over the life of that loan in one aspect. And they're all starting to transition to the 365, 360, which makes them more money. So you want to start looking at, the deal sooner than later, but once you sign a term sheet, that's really the start of your time period to what it takes to do a loan. And typically start to finish is 60 days, what we always tell people. Generally, we can get them done sooner than that, but usually it's 45 to 60. But if you're planning for 60 days, you're really hitting 85% of the situations. And even on a purchase transaction, there's certain thresholds that we encourage people to get us involved with earlier than later, because we can give you some insight on maybe some of your negotiating components, specifically financing contingencies. We like you to also try and negotiate and build in, and I encourage this, if you are buying a property, get a financing contingency if they'll allow it. 90% of the time they do. But also during that initial negotiation, negotiate an extension to that financing contingency. Because if you do it up front with the original contract and get it approved on the sale, you still might close 15 days after you release the contingencies. But if you do it up front, you don't have to worry about an issue as you get into maybe a delay in an appraisal or a delay in a survey or something. A lot of times what happens is that if you do a 30-day due diligence period and then you need another 10 days, the seller says, great, write me a check for 50 grand, or 50% of your earnest is now hard, okay? And we prefer to really make sure that the deal's financeable before we advise a client to release their finance contingency. Because there's always something that could potentially come up that doesn't often happen. But if you have that contingency in there, it's protecting you and your money. And the earlier we're involved in that discussion, the better off that discussion can be had, and it becomes part of your negotiating component. And we highly advise it. We don't always get that, but a lot of times we'll get, I'm under contract, I've done my due diligence for 2 weeks, I need to close in 21 days. We would probably pass on the project unless you can get an extension, just because we know what it's going to take to do it. So the sooner you get us involved, a lot of those things can be addressed. Also, the sooner that we're involved, we can explore the financial position of a borrower. And today we always get, depending on the platform, we get requests for pre-approvals. We're glad to provide them. And typically what we're really approving is the financial profile of an individual, not necessarily the property if we haven't seen the data. So we're looking at the credit worthiness, we're looking at the assets, liabilities, experience. And based on that credit profile, we can issue a pre-qualification approval letter all day long, very comfortable in doing it. Again, sooner that we're involved, the better we can do that. And as we also see purchases, there's a lot of times where you're involved in a product and you may bail out of that halfway through it. And maybe you could have not even looked at it. Right now, we're exploring a lot of properties for a lot of clients that just quite frankly don't cash flow, because of COVID right now. So depending on the price and the requirement of the client, case in point, we've got a client that's got $1 million to put into the deal, but every property he's currently looking at requires about $1.2 million. He's not going to put any more than that. So as you get into these properties, he's probably looked at 10 and one hasn't quite fit yet. So, and we're glad to look at them and offer some assistance. So those are the things that we like to see. Plus, it also allows us to assist in the structuring. Vesting is something that people don't think a lot about, but when we're early in the deal, we can talk about vesting structures, LLCs, S Corps, C Corps, trusts, if you've got a trust or not have a trust, how it all structures. Those make a difference to the loan. Excuse me.
And I'll just make a comment, right? You hear a lot about as you scale up in multifamily investing, this concept of a team, right? It's there's a team that you have that are your direct partners, but then there's the extended team, people like yourself, the property management company. As an individual looking at a property, there's only so much that you can do at one time. So engaging somebody like you earlier, you're part of the team that's going to help them negotiate, keep them out of trouble. And just as an example, I looked at that one deal that it was underperforming, COVID problems, collecting rent, and I was pretty conservative in my underwriting. Ran it by you, and you were a lot more conservative than I was. And based on what I knew that the seller had bought the property for before, saved me a lot of time. Don't even waste my time. Move on. It was great advice. So
appreciate that. Thank you. I will tell you that we prefer, and how most of our structures work is we become the point person for a project. And there's a lot of reasons for that. On any given deal, we manage approximately 15 to 20 people in a transaction. And that's not, we're any different than anybody else. Just on the money side, we've got a lot of things coming at a deal. So if you're doing a purchase, for example, you're dealing with the sales broker on the sell side, you're dealing with the buy side broker. We're dealing with our client. We're dealing with the client's CPA. We're dealing with the client's attorney in a lot of cases. We're dealing with the property side. Now we've got property managers. We're also dealing with an insurance individual relative to the property, which is a piece that we have to get. Insurance tends to be a little bit of the stumble block in a lot of projects. People don't think it's that important, when in reality, insurance tends to be the one component that slows a project down to close at the end, because it's not looked at as being an important piece, but it is very much important. So we're managing appraisers, we're managing the survey guys, we're managing PCNA, property condition needs assessment, environmental folks. All of these pieces have to come together at one time to actually create a complete package in that process of 60 days. And in the lending business, what happens is that when we start a project, a term sheet signed, a deposit check is issued. The deposit check typically goes to those third parties. We're trying to manage those third parties to hit the property somewhat simultaneously, because what ends up happening is you got an appraiser that goes there one day and you've had to post notices. So now you've made the tenants angry and property management's angry. Then the next day you've got a phase one environmental individual that has to go there. You got to post notices. So now the property manager's mad again, and now they've got to go find new tenants, or maybe they select the same ones if they like them. Maybe they're not so mad, but if they got to go find other ones, they're mad. COVID, we have issues today of not being able to enter the facilities. So that creates a different dynamic. Surveys, same situation. If we've got a property condition inspection, not necessarily environmental, again, another third party that has to get in. All managing that has to be done and tried to be done to where it's minimally invasive to all the players to keep everybody happy. But all of those documents have to come in along with the documents coming in from our clients and respective other players in the project that all come together. Once that stuff comes in, contrary to, I guess, the thoughts in the business is, you've sent me a piece of paper and I've said, it looks pretty good. Once we collect everything, it'll be submitted. Once everything actually comes in, then it's physically submitted to the underwriting. Okay, not before. Underwriting gets it from us, but underwriting doesn't look at it. Underwriting has got what we call a pipeline, a stand-up pipeline of multiple transactions that they're looking at. We send in one piece of paper, they're not going to stop what they're doing to go look at that, make sure it works for your project. So the more we manage those files, and a lot of what our firm does is we do a lot of that upfront paperwork, so that, because we're used to doing it and it's easier for our clients just for us to handle it, send you out a bulk package and say, sign here, review it, sign it, review it, initial it. Then it comes back and we've got a majority, if not probably 90% of the documentation already handled and in. Then it goes to underwriting. Managing all of that until the third parties come in, they won't even look at a project anymore today. So you've got it, it's there. We know what it looks like. We know we're comfortable and we're having dialogues, but they're not taking it through the initial process for full approval until, until everything comes in. And everything includes third-party reports. So the more we manage that, we try and coordinate that expeditiously to get everybody there at the same time. Different for most. I'm on every site visit, every appraisal for certain reasons. It helps direct things that need to be said and things that shouldn't be said. You'd be amazed at what gets picked up in a general conversation from a third party. So, and sometimes it may be, I've got a property, I'm building 100 units right next to the one we're doing. It's 100 units that we're underwriting and we're going through and appraising. I got a client building 100 units next to it, owns this one as well, starts talking about how great this next project's going to be. It's going to be far better than this one. My appraiser walks away and says, I have a problem because that new property is going to rob from this one, so I'm increasing my vacancy. Those are things you don't want to say. So we tend to try and shield that. And just little things like that, you never know. They pick up on more than you can imagine. There's a lot of snapping of photos that go on in every inspection, and understanding what they're taking a picture of helps. And being involved, there's always going to be a negative or a detriment, but you want to have a positive pretty quickly. If we have a project and we're in it early and we see a challenge with something with the players or the project, we like to talk about it day one. Let's bring it up. Here's the solution to it. Here's the problem. Let's fix it now. Or here's the rebuttal to that. This is what you'll find. We've already been aware of it. Here's what we're going to address. Get past it. Move on. If it comes up 3/4 of the way down, or something's found that could have otherwise been made aware of earlier, you lose the trust of an underwriter. And again, they're people. Underwriters and credit guys will decide not to do a deal pretty quickly. So they don't need it. They don't want it if they're concerned about trust. So understanding those nuances, helps. But again, managing all of those people are without a doubt a project. So we've had deals where there's 20, 25 plus. So it just depends on how many investors you've got in your mix. And that goes back to the structure of the deal, the entity. If you've got an LLC that's owned by a trust, or an LLC that is owned by 3 other LLCs, and then each LLC has different members/managers, or we've got a manager that is not owner of the property, he manages the LLC, but he's not a key principal, we call KPs, or going to be a guarantor on the transaction. That changes the underwriting. Who's actually going to be on first here? So understanding those things early is better for a client group to be able to know where the pitfalls or the curveballs are going to be in a project. So long-winded answer, Chris, to your question about when's the best to get in. It's early, as early as you can. Typically the process is you're going to sign a term sheet. We're going to open title and escrow. We're going to get the third party guys going. We're going to put all the paperwork together. We're going to start gathering all of the components, setting up calls with the underwriters and credit team, getting those assigned to the project, and then moving the process forward to third party reports. Those are going to come in. Once they're in, you've got underwriting, and then you've got credit. So typically your 60-day window, 30 to 45 days, you're doing a lot of the work. Once you've got the approval on I'll call it the 45th day, we're closing a loan in a week or two, depending on how fast we can get loan docs and all the players assembled. Whether it's here or, abroad, believe it or not, I've actually done a deal where we've sent it to the Costa Rica embassy. We've done it to Thailand. I mean, it just depends. I've got a client right now in Asia that we're doing a deal with. But he's got properties here. So it does help the more time we have to do a deal, to be involved in it, and early is always better. Any questions with that?
I think we've got one question that came in the chat, Stephen. We'll just go for another 5 minutes. I do want to, give everybody a chance to do a little bit of networking. The question we've got here is from Tony. He says he might be
How come I talk so much?
And no, I mean, guys, if you can't tell, Steve really knows what he's talking about. He's a pretty knowledgeable guy. I hope you guys have been taking notes. So Tony says he might be doing an exchange in a couple months. What's the best route for getting a loan from individual to a non-recourse? corporate loan. Not sure what the corporate.
Yep.
Tony, if you want to clarify that.
Yes. So Steve, I'm looking to do an exchange. So right now, I mean, my position is I have the property underneath an LLC. So,
Okay.
and if I were to exchange it into a different property, I'll probably end up getting a different LLC. So I was thinking about selling the property as an individual myself, and then getting a non-recourse loan on the new property on the upleg. But I'm trying to figure out a route how to do that. Would you be able to advise on that?
Yeah, I'll make a statement. Consult your advisors, CPAs and attorneys, as well as accommodators. Generally, what you'll find is if you're selling an asset under an LLC today, you need to stay in that LLC when you're transitioning to as an exchange component. If you turn around and take it out of an LLC and go to an individual, you'll blow your exchange opportunity. If you and again, consult everybody, but depending on because all these components have variabilities to it. But if you change vesting in title today from an LLC to your individual, then sell the property. Then you're actually, I don't know if it's just you alone or if you've got partners.
It's me myself. That's my plan, though. It is under an LLC now, so I was going to go to myself and then purchase the property myself to go by the regulations of the 1031, and then switch it over to the new asset over to LLC. Okay,
so you're going to sell the property under an LLC to yourself.
No, I'm going to I was going to switch title of the vesting to myself as an individual.
Okay, if you switch title to yourself before you engage and sell the property, then you can transition to an exchange in your name, because that's a selling asset or selling entity. I will say you don't necessarily have to do that for a non-recourse transaction. If you do go non-recourse, generally non-recourse lenders, whether it's agency or CMBS at Wall Street stuff, they'll require a what we call an SPE or single purpose entity, or it's basically liability remote, or trying to think of the term that they actually refer it as, special asset entity. So an SAE. So they would prefer that, and in a lot of cases require in non-recourse lending that it is under an entity, an LLC, as opposed to the individual. It needs to be protected that way. That would be the advice I'd give you, is if you're going to go non-recourse, then I would stay with the LLC. What is the reason for going from an LLC to the individual?
Just to sell the property and, to qualify for a loan, whether it's through Fannie or whatever institutions that are out there. My thing is at the end of the day, I know the upleg is going to be changed into an LLC just for asset protection wise. So if I can do that and actually get a non-recourse loan on it, then, I would prefer to do it that way. But I have no issue selling the property underneath as an individual, purchasing as an individual. Yeah, just looking for some options. That's all, I guess.
Yeah. I mean, if you're thinking that you need to go to a private individual's name as an owner to make that happen in in a non-recourse loan, that's not the case. Quite the opposite in a lot of cases. You're better off staying in an LLC and not going through the headache, unless there's another reason you're trying to exchange it out of that. But if the LLC owns other assets or something like that, that might be a different discussion. But if you've got an LLC now with that property and you're going to sell that asset and exchange it, it seems that you're taking a step that not necessarily needs to be done. That you can just stay with that LLC and incorporate that into the new property.
It's probably going to be out of state. That's why.
It's okay.
So,
that's okay. You can have an Oregon LLC as an ownership. You just have to register in the state that asset is located as a DBA, basically.
Got it. I think that might be the best course then.
Yeah, I mean, typically that, even if we've got, we do deals with clients out of area all the time. but you just have to register the entity as the ability to do business within that state that you're operating in as an owner. So in 90% of the cases, at least every state that we ran into, we're doing a deal in Mississippi with a California owner right now. We're doing a deal and 2 deals in Alabama right now with a Portland, Oregon owner. So again, it just depends on what you're trying to do in what state. But I specifically in non-recourse, LLCs are really the preferred move. And non-recourse, it's probably a good thing to touch on. We do a lot of both. Non-recourse lending, has some limitations and on what you can and where you can go. Typically, non-recourse lending in typical life company platforms or bank platforms are low leverage. So if you're doing a deal at 50% leverage and under, then you can get into the non-recourse lending. If you're doing Fannie, Freddie, or HUD, non-recourse is the norm. Predominantly, if you're not familiar with it, non-recourse, effectively in old school thinking says that I don't have a personal liability. Should we get sued, they sue the entity. It's not ever really the case, and I guess it was years ago, but today non-recourse is not the same as it used to be. It used to be a half a page of things that would trigger non-recourse to having recourse happen. Today, it's a page and a half of events that could trigger non-recourse into recourse. So, but non-recourse plays well into investment groups where we might have multiple assets owned with different groups of individuals. Maybe 4 people own property 1, and only one of those persons is on property 2, but they have 3 other partners on that property. So having non-recourse in that scenario makes great sense. And more importantly, from an underwriting standpoint, when we underwrite loans, non-recourse lending is taken out of the underwriting methodology as an obligation for you. So when we look at a loan and your ability to pay back that loan, we're looking at the property on a recourse loan, but we're also looking at your other debts and income streams, being that it's everything is being looked at. When you're looking at non-recourse, the only thing that's being looked at is the property, that one piece of real estate, that one asset. And we separate those things out. It's called a contingent liability. You're not liable in a non-recourse loan. They don't care about the other liabilities to some degree. But in a recourse loan, 100%, we're looking at all those liabilities potentially impacting another property. So non-recourse, we do a lot of, love it. It's great. Fannie, Freddie, HUD, we can go full leverage all the way to 75 and 80. It's pretty typical for transactions. Non-recourse, we don't get into tax returns. We don't like them. I hate tax returns. I hate underwriting them. So, if we can avoid them, great. And again, we start getting into recourse lending. I've got clients that have 42, 45 companies. And in recourse lending, you're underwriting them all. So in non-recourse lending, we don't care about the 42 or 45. So there's advantages to going non-recourse if the property can do it. Typical non-recourse lending is $1 million loan and up in agency debt. So if you're doing a transaction under that, you need to be lower leverage to go non-recourse, because now we're dealing with institutions that will do transactions under $1 million. But typically minimum numbers when you're dealing with Fannie and Freddie and HUD. HUD to me, minimum's 4.5 to 5. It's expensive. I don't necessarily advise it if you're doing a loan transaction under about 4.5 million. Really difficult to swallow the expenditures related to HUD as far as third parties and legal fees, et cetera. But about $4.5 to $5 million, HUD starts to make really good sense. That platform, just to give you an insight, construction lending, you're doing a 40-year AM with a 40-year term. Typical financing on acquisitions or refinances, you're doing a 35-year amortization with a 35-year fixed term. HUD's rates right now on a 35-year fixed term is probably 3%. So fantastic deal. But you've got a lot of teeth to that. And typical process for HUD minimally will take you 6 months to do a deal, minimally. So on a purchase transaction, which we've done a few on purchases where we've had a client cash purchase the property for whatever the number is, and then we turn around and start the refinance. because it takes so long. Most sellers won't give you the time it takes to do a HUD loan. So we've also done bridge lending, where we've got a bridge player that will come in and do a quick bridge loan, buy it, and then, you know, cost you a little bit of money and interest accruing, but allows us time to take to the HUD deal. And you won't find a better deal from a rate structure standpoint, but it's not without its challenges. So Fannie, Freddie, all day long, 30-year AMs. Most apartment lending, you'll see 30-year amortizations. Very few companies will do 25 if they are. There's some banks that some folks have come to me and said they were getting a 25-year amortization. That just happens to be that particular institution, but most of them are 30-year AMs. So, and the higher the amortization, better the cash flow. That's really what it's about.
Steve, this has been amazing, man. This is obviously, I mean, we could probably do a completely another session, and you probably have just as much information to throw out, and really appreciate you coming on today.
Well, I appreciate the opportunity. And again, I tend to spew out a lot of information. So if I'm talking too much, just, you know, let me know. It's something that we do a lot, talk with people and make sure that they're really, I want you to be well informed. I mean, the more informed you are, the better you can make your investments and do the process. So we're glad to help and glad to educate and help through the process. So
yeah.
And Steve, I will in the so both for the Portland meetup and the Eugene meetup, we can we'll dump Steve's contact information into the to the group, so you'll have it for your convenience. For when you need it.
Glad to help. And anybody has any questions, feel free to email me or call me. I'm glad to look at specifics. Great.
Well, Steve, if you want to hang out for a few more minutes, we're going to break it out into some small groups. Sure. Just do a little bit of networking, and you guys hang out for a little while longer. Turn on your cameras. Never know, you might meet your next partner right now. So let's get to know each other a little bit better, and we'll do. So we got 10, so we'll just do 3 groups.
Someday we'll be able to do this in person.
Yeah, maybe. Hopefully.
We're going backwards in Wayne County.
It's starting to open up, yeah, but I think it's going to close back down here from what they're telling us. So
yeah,
we'll see.
All right, we'll go for about 12 minutes. Just be respectful of everybody's time.
So do I hit a button or not?
Oh, let me, hang on, sorry. I did that wrong.
And I don't know if we covered everything for everything that you wanted to do, but I hope we covered a good part of it.
I think it was I think it was good, Steve. I mean, just detailed on every point that you hit too.
Well, hopefully not too detailed, because it does tend to get bogged down in those details, and it drags out. We'll miss a few topics because of it, but yeah,
no problem. Everybody's going to come back right now. I somehow only did those rooms for 5 minutes. So I'm going to open those. I'm going to bring everybody back, and then I'm going to send them all into their small groups again. Okay, so let's go. Sorry about that, guys. We'll go again here. And all right, now we're going.
You want me to just hit the join?
Yeah, so if you just hit that join, and then
So, I try to soak up as much information as I can. How about yourself?
Yeah, I haven't had a twisting journey. We've been like long buy and hold short-term single families for a long time. So we've got like 5 single families, and I manage them myself and Portland hates landlords, so it's really fun, but I somehow figure it out. But I've just recently started a business as a actual investor. So I'm looking for off-market properties, and I'd love to kind of learn about flipping. Ultimately, I'd love to do some more creative financing like sub twos, but I feel like multifamily is kind of where the cash flow is. I know nothing about it. I love the idea of it. So I'd love to learn more about multifamily, but so I'm recently full-time into investing, just figuring out my marketing, but I also wear the landlord hat too with our properties. So yeah, that's kind of my story in a nutshell.
Did you say that you're in Portland too?
I'm in Multnomah. Yeah, man, the law. I want to run for city council on garbage and like pro landlord. I tell you, it's just the fact that it's inventory list. I mean, you count your doorknobs. Like, who came up with that? So frustrating. I just literally. Yeah, it's very frustrating. Do you have management companies? I'm assuming with multifamily, or do you?
So I had my property management license a handful of years ago, and so I manage our small commercial office building, but the it's not the best use of my time.
Yeah, right.
And I'm trying to stabilize it, which, you know, we've been 100% occupied through COVID, which is a blessing.
Yeah.
But the idea is I have a partner that I want to hand it off to. Probably like a lot of people in real estate, I probably should have handed it off a year ago. But I'm still, you know, taking the phone calls and whatnot.
Yeah, I want to get an assistant. That's my plan. I want to get an assistant to field like the least. I mean, I feel like every turnover is just like fielding calls and silly questions, and you have to navigate all the laws. And it's such a time suck with.
So that's actually, it's interesting you bring that up. That's my goal this year. Is I have some personal rentals too. Is I'm going to hand them off to a management company. My time's just better spent not managing that. In fact, I was at a property today just showing a handyman some, you know, broken fence posts that he needs to replace. And it's kind of wondering, what am I doing out here? So
Right, yeah.
but I also like it, you know, it gets you close to the properties, but, you know, I think I just need to shift gears. I don't know if you guys can relate to any of that, but.
Oh, totally. I've had these college kids, and I feel like I'm running a rentals 101 course because I don't understand how move out works. I'm like, all right, so you got to get it cleaned. And I'm just like, it's pretty basic, but they're like confused about the whole process. It's like their first rental. Yeah, I'm like, I'm over it. Anyway.
So Ryan, my name is Matt, obviously, and I'm in Portland, and I started a real estate investment company about 3 years ago with a business partner. And we have a mix of single family rentals that we actually primarily rent out to a nonprofit. We just kind of fell in backwards to that, which has been great. And then we're building a couple multi-family properties.
Okay.
And then we own a small commercial office building where they're like little micro office suites, about 300 to 500 square feet. And I was really scared when COVID hit because I'm like, oh crap, you know, we're going to lose all of these little tenants. But it's been quite the opposite. We have a lot of people who didn't want to work from their home, and they just need a little spot to plug in away from their kids and the noise. And so we've been full. But I've been interacting with the banks a lot with financing, and I have a lot to learn. And so this, Chris Freeman invited me to this topic, which I really enjoyed, because it feels like most of my time and effort spent now is on acquisitions or financing.
Sure. Yeah. Okay. Yeah. This. I'll make sure I send out the recording to everyone. I know Steve was like, what do they say? Like drinking through a fire hose. There's a lot of information. It sounds like he's got plenty more to share.
Who's Steve? What company is he with? I missed the very beginning.
Yeah, it's AFM, I believe, is the AMF Capital is his company.
Okay. And then so you're in Eugene, Ryan?
I'm in Eugene, yeah. So I've been running. Oh, we lost Shauna. Been running the Eugene chapter for about 6 months now.
Oh, okay.
Yeah, and then Chris and Denny actually just started the Portland chapter last month. So I figured we'd team up and try to grow each other's chapters a little bit. I'm currently invested in 160 unit syndication deal in Phoenix.
Okay.
and then I'm under contract on a storage deal in Mississippi.
Wow.
Yeah.
And how are you coming across those out of state?
So the Phoenix deal was, I'd been looking for syndication deals to syndicate myself in Phoenix. And when I first got started, I was just trying to network with people down there. So I typed in Google syndicators in Phoenix, stumbled upon this guy, scheduled a call with him, built a relationship with him, and that was just, we've continued to grow that relationship. They're one of the fastest growing syndication teams in Phoenix. So put in a small investment with them, and I say small, it's not relatively small. Yeah. But yeah, and
are you with Blue Holiday Capital? You're kind of in your background.
Yep.
Okay.
That's my company.
Okay.
Yeah, so I had been really focused on that Phoenix market for probably the last 6 months, looking for stuff on my own, gotten close on a couple deals. Had never really looked in backyard like Eugene, Salem, Portland. And up until about a week ago, decided, committed to like, hey, this is going to be another market that we'll look into. My wife's a residential realtor.
Okay, so is mine.
Yeah, cool.
That's cool.
And I work in construction right now.
Okay, that's perfect. So you have a good eye for, when you look at, so is like new construction?
Yeah. So we're a drywall subcontractor, and we do a lot of multifamily, mixed use, decent amount of single family as well.
Okay.
Yeah.
Familiar with that. I think one of my neighbors is actually that kind of a board for like acoustic ceiling, drywall, and something else, but he actually runs the board, the association maybe that your company's part of.
Okay.
Yeah. So I'm a little familiar with that.
Northwest something. Yeah, I think I've seen the magazine.
He actually runs it. He was pretty brilliant. He started it and then went around and just started getting, companies to join, and he just kind of started it himself. It was pretty brilliant.
Oh, wow.
Explained it to me. Yeah, so I think I forgot the gal, Shona, who was in here. I was explaining that, I went off on my own from my W-2 to real estate about 3 years, well, I guess 2 years ago. And we have a mixture of investments because we didn't really have a focus. We were taking deal by deal, and all of a sudden, we had this little hodgepodge of deals, which is great. But I realized that, I kind of had to have a focus and more of a niche to get some momentum.
Okay.
And so now, like in this year, we're trying to retool and focus on that. And so we're trying to do the multifamily, maybe to add forced appreciation or value. This market's super tough, but I know there's still deals because they're everywhere.
Yeah.
It's just you have to find them. But so that's my focus right now. And then maybe some fix and flips. Again, a bad market for that, but we have a credit line established, and it's unused specifically for fix and flip. And if I find the right opportunity, especially if it's multifamily, I can do up to 4 units. I'll do that.
Okay.
But again, it's been super hard to find any property right now.
Sure.
With the market.
Yeah, we actually we're considering a property for a flip right now. Property that my wife is getting ready to list next week. And she's telling me about it, and she says they're asking 85,000. Everything else in that neighborhood is getting around 320. So she said it's a big price difference. Yeah, she said it's pretty rough, but we've got all the contacts, and like you said, an eye for it. So like if I went and inspected it, I can probably tell it's either a tear down or or that's something we can work with. Yeah.
Well, even a tear down, I have to imagine the lot is more than $85,000.
Yeah. I mean, the lot in that area is at least 75. Yeah.
Interesting.
So what size are the the development deals you're working on right now, Matt?
So my business partner is a developer by trade. So the one multifamily is 138 units, and we're co-developing it with another developer who's
Okay.
more of a syndicator. So he syndicates the deal, and we put our money into it, and it's co-development.
Gotcha.
And so that's one. And then we're actually doing an assisted living. So we partnered with a assisted living company out of Salem to be the owner operator.
Okay.
And we bought the land, but we're contributing it to the JV as our portion, and then we're running all the entitlements. And so that's
Gotcha.
kind of a piece of that. But it's all great. But the time period for it being stabilized and any cash flow, it's 2 to 3 years.
Yeah.
And so, you know, it's a good problem to have, but then short term, we're wondering, we kind of have to find some other projects to fit in between.
Sure.
For cash flow, but.
Okay. Yeah. Let's say we got another minute or so left here, but I'd love to connect with you offline about those development deals, because that's actually where, you know, being in this business and doing deals like that, because that's kind of like where most of our work comes from, is multifamily, 100+ unit type stuff. I always thought it'd be neat to be on that side of the table.
That is, and what's interesting about it is it's actually, once you get into the new construction piece of it and you've gone through the process, it's pretty straightforward and simple. You know, you're just, it really is. And so then the epiphany for me is it seems much easier actually than go and find an existing property. Just go find, you know, the right zoning, the right piece of land, and put all the pieces together and build it, and away you go. And it just seems like it's been an easier process, to be honest.
Yeah, and I imagine once you've done it with the city or the county or whatever, you've got a little bit more pull and, you know, how you want the project to look and how you want it to go.
Yeah. Yeah. So I can send you my contact information. I'd be happy to talk to you and learn from you too. And
Sure.
swap. So
So
what's the best way for me to give you my contact information?
if you want to drop it in the chat, and I will, I'm going to go ahead and post all my info here too.
Oh. Little
Or if you just want to grab that email and.
Yep. And my cell phone. So it was nice meeting you.
You too, Matt. I think sometimes these breakout rooms, I'm not real sure.
Yeah, I hope we got that covered.
Yeah, we're good. I did.
Yeah, okay. Yeah, that's something I'd encourage. Just go ahead and do that.
We'll do it. We'll do it. That sounds great. It's been great talking to you.
Thank you.
Appreciate it, guys. Anybody else have any questions? You want to call me names?
Questions, Steve, but thank you for all the information.
My pleasure. Yeah, glad to help you guys.
Yeah, and I'll give everybody one last chance to throw your contact info in the chat if you'd like. Go ahead and drop my information there. And you can save that chat so you don't need to jot all those notes down.
Matt Keister, how you doing?
Good, Chris. I got kicked out of my house, so I'm sitting on my bed right now because I have kids and wife that doing a transaction right now, and so
Yeah, that's the life we live.
yeah.
Sometimes that's not a bad deal. I've been married 30 years, so I'll take that one of these days.
Hey,
All right, folks, yell at me if you guys need me, and I'm certainly glad to help anybody there. So
really appreciate it, Steve. Thanks so much. And then just for your guys' information, so we'll keep this consistent. We'll do the last Wednesday of May for our next meeting, and we've got our very own Chris Freeman is going to be talking about his journey and how he got to where he is at a little over 100 units by himself and his father-in-law. So
Sounds good.
Okay. Well, thanks everyone. Nice seeing everybody.
Thanks, everybody.
appreciate it. Thank you, guys.
yeah,
Have a good
thanks.
night.
Thanks, guys.